What is up, YouTube? This is the Working Investor. Today we're going to talk about the market. Is it a bloodbath? Is it a shopping? Is it time to go shopping? And also, we're going to talk about how my hedge strategy has worked out. And so far, it seems to have protected me from the volatility of the market to an extent. My position is down a little bit from the option side of it, and I had to take some losses. But with my synthetic high yield dividend covered call strategy through YieldMax, let's talk about Fiat and Coney sandwich. We'll go through each sandwich, and you'll see I put $5,000 into this sandwich, and you'll see that I'm not at $5,000, but I'm close. I have 2,782 in Fiat, and then Coney went down to 2,067. So it's a little bit over $2,800. So I'm less than $200 down from a $5,000 position. And then with my Tesla and Crash sandwich together, again, there were $5,000 into the Tesla Crash synthetic cover call versus synthetic covered put ETF. And basically, you'll see here 2108 in Tesla and 2894 in Crash. So you'll see here that it's actually quite whole. I think I'm just a little bit over. Actually, yeah, just about perfectly, maybe $2 up, which is extremely insane in this market to actually not be down and actually be $2 up. So the Crash has really done a good job hedging me against the Tesla. And don't forget, I make premium on both sides of it. So, and with the YieldMax, of course, we don't know if the YieldMax funds, in a way, you could think maybe the premium may not be the same. The dividends may not be the same because the dividends are a distribution of the premium they collect. Or what you could think a different way in saying, because implied volatility is up, to be as an option seller, it's more rich if you're selling options. So maybe future premiums may actually be better, but it depends how they play the game with their strikes. And then I have the NVDY dip. I did a couple changes. So NVDY dip, I did put additional $1,000 into NVDY because I had to buy the dip, and I also put additional $1,000 into dips to hedge against it. So I used to have $5,000 total in this combination. I call it the two parts which equal the sum. $5,000 total, $4,000 in NVDY and $1,000 in dips. So I was thinking like maybe a 20% buffer, hedge, but I wanted to bump up my hedge a little more. So I put 2,000, so I put a total of 2,000 in dips, so additional 1,000 into the dips. And I put additional 1,000 into NVDY to lower my cost basis. So I have $7,000 total into this position. Again, it's not a perfect one-to-one hedge like the previous two sandwiches, but it's more like a two. There's 7 parts, so it's 5-2. So basically, I am down in total in the position. But you'll see that I'm down. So I have 7,000 total, and if you add up 2,035 and 4,542, it's 6,000, 6,500, close to 6,600. So I'm down like a little over $400 in a $7,000 position total, which would be better than just having NVDY without any buffer. Dips didn't do the best job as the other ones buffering me with the position. I guess it depends on where their strike prices are. You'll see that total, like you would expect dips to go up, proportionate to what NVDY goes down or close to proportionate. But it seems like it's just kind of hold my position where it is, maybe up like a margin, like 0.54%. But the fact that it is at least holding up my position and not losing, and I get high yield dividends, and NVDY had like about 100% return, annualized return, and those who held NVDY from the beginning of inception till now, I think I had like 90% of their money returned to them. So once you get 100% of your money returned to you, then you're just playing with house money. So if dips just holds up, it still has some benefit, because again, I did not put my entire allocation that I wanted to put to NVIDIA. I kind of split some of it into the dips, with AMZY, I am down in AMZY. I don't have a hedge against it. So my strategy is to, I was targeting to I did buy the dip today. I put additional $1,000 into it. I do have some more funds, some more dry powder. I'm thinking if it really drips more, I'll buy more on maybe ex dividend date when it really drops down, get a write up opportunity. But I got in today 56 shares, as you could see here, for a price of 17.90, which I since like it was almost the lowest since the market opened. 17.90 seems like it was one of the lowest. This was all pre-market, and 17.90 seems like it's one of the lowest prices I could have gotten in into the position. So I reduced my cost basis to 19.97. I'm down $1,500, 8.85% in the position. I'm okay with it because I'm not panicking. I'm actually looking for a good opportunity to buy some more, either before ex-dividend if it continues falling down, or on ex-dividend date. I do have some more dry powder to put in there. I did take, as far as my options, I did close up my NVDY option because NVIDIA is definitely, I feel like MicroStrategy and NVIDIA are like a little bit way overbought. I did put the put in kind of like, on vacation, not thinking too much about it. So if it's not something that my theory is always like, if it's not something you want to double down on, then don't even start it. But of course, I didn't follow my rule. At least it wasn't one of those little hype companies, like those like small cap, micro cap companies. So I mean, of course, it could go up, but I did close it out for a loss, about a 20, for like $3,000 loss, and on 100, like in a $12,200 position, I took a $3,000 loss, so about 25% loss roughly. A loss is a loss. You can keep rolling it and rolling it, but it's a loss. So, and I want to have my capital back. So, it is what it is. As far as my TQQQs goes, I'm not going to sell my long because these are leap options, and these are options that I bought with, not on vacation. And I did realize I did buy them like in the close to the top of the market, but I do have a year and a half to be right. I'm actually thinking of doubling down on the position. I was actually putting in some orders to try to buy some more $20 calls that expire 2026 for like $32 or $33, but it seems like it's already bouncing back, the triple Qs. So if it does fall further down, I do want to double down on the position, reduce my cost basis. And then as far as my Google right now, I'm just going to hold as is. I did roll for my 180 to 170 put. I know that Google's close to 160, but I'm okay. I'm going to see where things go as we get closer to expiration. I may roll it out further. As far as my Amazon 150 call leap option, that's almost 2.5 years out, 2 years and 4 months out. I'm okay because actually it was actually almost touching my position. It was almost like pre-market at 152, 151, but it's already bouncing back. Right now I'm not selling any poor man cover calls against my leap because I didn't find any meaningful premium yet. So what am I doing here? Whoop, get out of this. So yeah, so basically just going to hang out for a little bit over here, see what happens with the market. I am long Amazon. So that shows that this was the right move when I'm not panicking and I'm actually just waiting for opportunity, or like in the TQQs, thinking about doubling down on positions. That's a good sign that it was the proper move. Anyway, so this is the positions currently. I'm just sharing you what I'm doing. I'm just a retail investor. Hope you guys stay calm, cool, collected. There's a lot of opportunities, and this is the market where people become rich. This is the market. This is opportunity, guys. Don't forget about it. If you got some dry powder, if you ever wanted to make some moves, if you want to put moves in right now, kind of leg your way into it. It's up to you, but I feel like this is opportunity, guys. Anyways, this is the Working Investor over and out. Hope you guys are doing well and have fun trading.